Hey, welcome to the live stream. We have just finished the month of September with regards to stock investing, stock trading, and the month was a good one. September could be a month when stocks sell off, but it didn't happen this year. We'll see about next year. And we're on to the month of October tomorrow. And this year, S&P year to date is up 13.72%. Considering that we had a very good sell-off that went from, call it March into April, the S&P went down almost 20% during that time. Having an S&P that's up 13.7% is really good. Looking at the 12-month, it's 16% upside to the S&P, and that's a really nice rate of growth. Historically, that's above average. It's very good. And if you look at the 5-year, it looks terrific. If you put money in the S&P exactly 5 years ago, you'd pretty much double your money. Really, really good rate of return. So stocks have really been working for investors. Stocks have been a great place for investors to grow their wealth, take their hard-earned money, put it into stocks, and see their hard-earned money grow. Work at night, work 7 days a week in order to either fund some plans you have, retirement plans, or maybe you want to start a business with that capital. Maybe you want to have some experiences with that capital. All the above, if you grow it, you'll probably be able to do more with that money, with a bigger amount of money that you have left over. So this channel, what we focus on is investing in companies, a little more longer term focused, looking at fundamentals, looking at the valuation of a company, trying to see, do we have a stock that's discounted or priced at a premium? And we determine what the value is of a company by looking at a forecast of their cash flows and then discounting that forecast to today's value, and also looking at profits and being able to discount those profits to today's value, comparing it to the current stock price. In many cases, there's great businesses, but we got to wait for the market to sell those businesses off, and then we buy those stocks at a really good price. The market is a little expensive, so it's getting harder to find good deals out there, good bargains on stocks. But, if we're long-term minded, we have to exercise our patience at times. And today we're going to look at some stocks. Wanted to look at Nike since they announced their earnings. Then we've got one suggestion already from a viewer, and that is it's on the London exchange, symbol GAW, that Shadow Guy put in the chat. Good to see you, Shadow Guy. And good to see you, Mike. And it looks like you've got a comment there. Last couple of days have been brutal. I know last week was a little tough. I've had days over the last, call it week and a half, where I've been like opposite to the market. For example, today I was negative, and the market was positive. Overall, September was good. I think it was up 7% overall. So I'll take it. But some days I was like opposite. The market would be selling off and I was really positive. The biggest winner for the last 2 days for me was Robinhood. It just really went up. And yesterday, as an example, I really outperformed the market, and I'm outperforming the market this year. I'm up about 35% on my stock portfolio. The market's up about 13. Wow, it looks like we've got a good crowd of members. Looks like Big House Juice is on. Good to see you. You would like to look at Airbnb. I would be happy to look at Airbnb. Take a look at that vacation rental company. It has not been performing exceptionally well, but we're going to take a look at it. I'll give you my point of view on it. And Mike, Instacart's just been getting hammered. I agree. Dave is getting killed. Upstart is crashing. Man, these small caps, man, they could be frustrating at times. And I tell you, I've been buying Instacart, and we can talk about cart. And I think that the market takes stories. It almost takes the conclusion at face value. For example, Instacart. Amazon's going to deliver groceries from the grocery stores. Oh, well, that means Amazon's going to put them out of business. It seems that the market reacted that way. And the second item was DoorDash is going to start delivering, I think, for Kroger or partner with Kroger. So DoorDash does a great job of delivering, um, food, and they may do a good job delivering grocery, but we don't know yet. But that news really affected Instacart, and DoorDash has been really successful. So that was the big news that led to the second sell off on Instacart. Dave is a small cap, and it's going to see that kind of volatility. The same thing with Upstart. I mean, those are new businesses, new business models. And when investors get nervous, I think those are the first stocks they want to sell off. They'll keep something they really are familiar with, something they have conviction with, and they sell off the stuff that's maybe less known and they have less confidence in. That's just the nature of investing. So we'll take a look at Cart. We'll take a look at Dave and see what's going on with those stocks. Okay, so one thing I wanted to touch on is we've got the government, and it's I think there's an argument in Washington over spending, and I'm not quite sure. To be honest, I'm not an expert, but there may be a shutdown, meaning there's going to be a disruption to some services, and some people that work for the government may not be working temporarily until they figure out the spending bill. And Poly Market earlier in the week, or actually earlier in the year, would there be, a government shutdown? The odds were not very high, but they began to climb. And most certainly now that we're the evening before the shutdown, 96% chance we're going to have a government shutdown. That makes sense. And that's interesting to see. We'll see how quickly they could figure that out. I'm hoping it's quick so that it doesn't cause too much of a disruption. Taking a look at, stocks, some stocks are flourishing, like NVIDIA. It's been incredible to see it rise, frankly. It's such a big cap and it continues to go up. And that's a big, big move for a company that has more than $4 trillion in market cap. The healthcare space, thanks to Pfizer, who met with the president and have a plan to lower drug prices, they're having a good day. Industrials had a good day. And so did a lot of businesses that are in hardware as well as semiconductor support industries that provide materials and components over to semiconductors. So you got to be a good stock picker and kind of understand where the puck's going, where the market's going, and try to be wise with your buys and your sells. So thanks for showing up, guys. Man, we've got a lot of action on the chat. Let me try to note a few, and then we're going to get right into it. So it looks like Brandon is on. You'd like to look at RNBY. Yeah, let's take a look at it. RNBY. Ben 10. So NBIS, is that Nebius? Man, Nebius and CoreWeave have just been on a tear. Incredible rise. Yeah, oh no, Shadow Guy, the shutdown may affect your flight. I don't know that it's going to affect your flight. I think all critical operations are going to continue, and airports, they're not going to slow down. And then Ben 10 AV Go has been carrying one of my ports. So is that Avgo Broadcom? Interesting. Okay, so let me go over Nike first. Nike announced their earnings, and let's take a look at where the stock's trading. So the stock's up 3.6, And when I looked at their earnings, I was not impressed. They grew revenue by 1%. Now the good news is it wasn't negative, but that's kind of like, it's not good news. It's just, oh, good. The good news is they stopped bleeding so much revenue because they had been losing, and I'll show you that in a little bit. They've been contracting for quarter after quarter, and finally they had a positive quarter. The other thing I didn't like is their margins went down. So those are two things I didn't like. Everything else is kind of, they're on their plan to recover. That's fine, but it's still not a desirable business for me. And I don't put them in a, kind of a desirable spot of a business. They're still having to compete with a variety of shoe companies. And, what's going to cause more people to buy Nikes? I don't know. And especially their product could be pretty expensive. And if you have alternatives that are less expensive, the consumer may be wanting to do that. So the earnings weren't all that great, in my opinion. And when we look at the stock, this is $103 billion market cap with revenues of $46 billion. The PE ratio is too high. They're not growing, and their PE is in the 30s. I could buy Google. They're growing, and that's 27 PE. Meta is about the same, 26 PE. And both of those companies are growing. So why am I going to pay a PE of 35 or 37 for a company that's not growing? No, thank you. When we look at their stock, I don't think their stock's doing all that great. It's down year to date. Over the 1 year, down 22. And look at that chart. Over the last 5 years, just has been abusing investors who bought their stock. When we look at their financials, this is where, if you look at the quarterly, you see how quarter after quarter it's just bleeding revenue. Like they just could not grow. And finally, they grew a little bit. They're celebrating a 1% growth quarter. Well, that's how bad the situation's gotten with Nike. And no thanks. I'd rather go find a business that's growing that has better margins. Their margins are decent, but you see how their margins are dropping? They were 45, 43.5, 44. Now they're 41.9. So that drop in margins, that's money that isn't going to go to the bottom line in the form of profits. And it's not going to fund as much free cash flow. So Nike just doesn't look all that great to me. The revenue growth, it really wasn't revenue growth. And analysts are probably rooting for Nike because, Nike's a pretty popular brand, but not me. I buy based on intrinsic value. When I look at the business, and I'm actually giving them a very generous valuation by using 2024 free cash flow, because their free cash flow in the trailing 12 months is lower. But just setting that as a baseline and saying if they could do near that number for the next 4 years, their intrinsic value is $113 billion. You add cash, take away debt, and the best case scenario, this stock's discounted by 10%. So I'd have to buy a business that is trying to put their business back together and begin to achieve success again. And I'm only offered a 10% discount on cash. That's not enough. It has to be compelling, like 35, 40%. The earnings per share have really dropped. And when I try to price the company using a P of 18, not a 37, Nike does not deserve a 37 PE. I could find 25 companies that are better than Nike that have a lower PE. So when I use my valuation, I get a 46% premium that's being priced into the Nike stock because earnings per share really dropped down to $1.68. I think they're going to grow in the future, but for now, the company isn't worth their current stock price. So overall, the stock is priced 8% too high. It's a total pass for me. I'm not buying it, not considering buying it. It's not an opportunity. If it was maybe discounted by 30, 40%, maybe I'd consider it because it is a very good brand. I'm not going to buy Nike. We look at Lululemon, it has a discount available. And I think Lululemon has a very good brand. It's smaller company. But if I was going to go into apparel, I'd rather buy Lululemon. I'm not going to buy either, but I'm just kind of showing examples of what's out there within consumer discretionary in the apparel industry. So Nike's a pass. I'm not sure why some investors are celebrating the earnings. I didn't think they were very good. And those are my comments there. All right, let's move it along. Looks like Pedro Miguel is on. Yeah, DocuSign and Reddit. I plan to go over DocuSign, and I didn't notice if Reddit was getting sold off. So let's take a look a little later. All right, so there was a request to take a look at Games Workshop Group. This company is in London, and let's take a look at their website to get familiar with this company. And I think I've noticed some of their workshops near where I live, just in like the strip malls and so forth. And I believe they make these items here. There are collectors, there are people that really like this type of item, and that's what they make. And I think they have kind of I think people are collectors and they kind of get involved in this kind of genre. I've never been a part of, but that's what they do. I guess there's memberships available. And so what's their business model all about? So they have fantasy miniatures. Okay. So imagine this product is not like cheap that you'd buy it like at Target. I think the items are probably have a pretty good price on them. Let's take a look and see if this is a attractive business based on fundamentals. This is a $4.79 billion market cap. Revenue is $617 million. P ratio mid 20s, and they pay a nice dividend of 3.5. The business is growing. That's pretty good growth. Yeah, it's very good growth, and it's been consistent. They've been growing year after year after year. That's very good. The fundamentals look good there. Let's see how profitable the business is. So free cash flow, consistent and growing. That's very good. Then you got gross margins that have gotten into the 70s. That's very good. So the business is growing, positive. They generate good free cash flow, positive. And their profit margins are 31%, very positive. Fundamentals look great for this business. So when we look at let's look at their balance sheet, see what their debt level looks like. And they don't have a whole lot of debt, $45 million of debt, and they have more cash on the balance sheet, so they can pay off debt immediately. So this business looks good. Very good balance sheet, growing, profitable. It's a good business to consider. The year to date, it's up 9%. Over the 1 year, 34%. Over the 5 year, it's okay. It's not great. You add that dividend, and over 5 years, you're probably up to 65% rate of return. It's not bad. It's not bad at all. So this business here, it's a small cap, and it's got very, very good fundamentals. It's got good margins, good growth, good looking stock. All right. So the comments are coming in quickly. Looks like so I know why DocuSign went down is ChatGPT came out with some type of document management solution, and immediately the market thinks, oh man, they're going to put DocuSign out of business. I don't know how the market makes such a quick conclusion, but that was the reason for it. That's why it sold off by like 12%. And I could talk about it later when I look at DocuSign. Yeah, looks like they're kind of a video game producer. That looks really interesting. I don't know that they're gonna be a high growth company, but they're a steady growth company, so they look good. And Robinhood did really well today. They did great yesterday. Just a fantastic 2-day run. Go Robinhood. And I did cover yesterday Robinhood. I covered Robinhood on a video and this morning when we had the member call. And my conclusion is it's still discounted, but I just think it's gone up way too fast. Probably it's going to give back some of those gains at some point. And it looks like Nike's getting a lot of comments. And I think Nike gets a lot of attention because everybody knows Nike. And when you have a product that has such a recognizable brand, it brings in a lot of investors, a lot of retail investors. That's good and bad. The bad part of it is we don't get a lot of discounts on stocks like that. So no real good discount on a business that's struggling. No, thank you. I'll go find businesses that provide a better investing opportunity for me. All right. So we have gotten through Games Workshop. And I think somebody wanted to look at Airbnb. Let's take a look at Airbnb. So Airbnb has not been growing tremendously fast, and I think that's what's weighing them down. When we look at their growth, it's decent growth, but it's not, incredible growth. To be incredible, you got to be 30% growth, 35% growth. And they were doing that previously, right? In previous years, they were really, really setting the bar high, 77, 40%. And they started to really slow down. And I think that's it's going to be hard for them to grow from this point. The piece that's hard is I think they've captured the market, and it's to the extent that they could capture a percentage of the market, and their competition is getting better. Booking.com is really good. And even VRBO or Verbo, as they call themselves, is really competing against Airbnb. Even the hotels are adjusting and providing properties to give families more square footage so they can stay in a home rather than a hotel room, which is more comfortable when you travel. The business does have some really nice, attractive fundamentals. When we look at their free cash flow, they just crank out cash. That is very good. Gross margins, 83%. Very, very good. So they have good profit margins, good gross margins, very good free cash flow. They have a terrific balance sheet, more cash than debt. See what analysts are saying about Airbnb. So analysts are saying it's got a 19% discount, and that the most favorable analyst has a price target at $200 per share, and the most pessimistic analyst is at 103. Now, looking at the forecast, they're going to continue to grow at around 10 to 11%. That's okay growth, but it's not great growth. So that's one of the things that I think is hampering the stock, the lack of growth, because I think Booking.com is growing faster. So their peer company is outperforming them. I think that's what's on investors' minds. That's what's on my mind. I own Airbnb. And earnings per share should grow. It's going to grow faster than their top line growth. And their PE ratio should drop down to the low 20s in 2027. So that looks good. So the business is good fundamentals. It's just that top line. They're not growing fast enough. That's their problem. And that's why the stock isn't, it's not exciting investors. It's down 5% over the 1 year. Year to date's down 7%. And even over the 5 year, these guys have not gotten on a nice upward trending trajectory on their long-term chart. It's just kind of been all over the place. And I've lost some confidence in Airbnb. It's not growing fast enough. That's the biggest problem. And they need to figure out how to grow, or their stock isn't going to really go places. I've been selling off some of my shares because I don't think the market really is excited about Airbnb. They are discounted by 34% because they really crank out cash. They are a very good cash flow generating company. They just have to figure out how to grow better. Maybe they need to acquire Lyft or just have a broader product catalog. For example, Booking, they don't just do private home rentals. They do that. They do hotels. They do car rentals. They do a variety of things. And Airbnb is trying to grow in experiences and kind of create organically a second business. I hope that works, but it's just not making it to the top line and really affecting it. They've been trying to do that for like 10 years. So it's not a new thing. So Airbnb's got to figure something out. Maybe they should have acquired another business by now, or they should think about acquiring a business that could help them just grow and become more substantial, have a bigger network power within the travel industry. So Airbnb isn't a stock that I'm all excited about. They do have a nice discount, but what's going to be the catalyst to take the stock higher? I don't know yet. They have to tell us, how are you going to grow this business and accelerate growth? And why is booking.com beating you based on growth and performance? So that's my review of Airbnb. It hasn't really done all that great. I've been lowering my share count of this position, selling off Airbnb over time because my confidence has gone down in this particular stock. So that is Airbnb. So what is going on with Instacart? Boy, it's getting beat up by the stock market. Let's take a look. So the first story that took the stock down was, hey, Amazon's going to be a threat. And yep, the stock sold off. And then more recently, it's DoorDash is going to deliver for Kroger. Okay. So I guess shame on Instacart. You got to get out there and just dominate the market. Instead of letting DoorDash, be a partner with Kroger, why didn't you lock down that partnership? I guess it's a little bit of a critique on Maple Bear or Instacart. Now that's what's causing the stock price to sell off. These guys are doing well from a overall perspective. We have a company that's growing 10%. If they can increase that growth, this stock's going to flourish. And we're back to kind of like what I just shared about Airbnb. If you can grow a little faster, maybe 15%, 20%, we have no problem. Their PE ratio is very rational, considering they're growing. They're very profitable. They generate cash flow. All those things look really good. Balance sheet's great. Just the market is seeing that there's more threats to the Instacart business than desired. The threat from Amazon, and now a new threat from DoorDash delivering with Kroger. So Maple Bear has got to deliver some growth when they announce on November 11th. This is a discounted stock. I have been buying shares in Instacart. I like the business model, but at a certain point, I have to stop buying shares and just wait to get more information. This is a highly discounted stock, discounted by 61%, and they're an acquisition target. This would be a beautiful business for somebody to acquire, somebody that wants this grocery delivery business. Heck, maybe even DoorDash acquires them because they're not that big. Their market cap is less than $10 billion. Or maybe, who knows, maybe Uber or somebody else acquires Maple Bear because they are the, kind of like the specialist in grocery delivery. So that knowledge and ability to execute to the customer in that area, I think is really valuable, and they're very, very discounted. So Maple Bear is, I think, a rational investment. I don't have a giant position in them, nor am I going to have one, by the way. I'm looking forward to seeing what they have to announce on the next earnings, but it is a very discounted stock, offering investors a very, very good, compelling discount. So thanks for asking about Instacart, guys. And I know they have been getting beat up. Looks like Lauren is back. Man, you are quickly becoming the number one super chat buyer on the streams. Thank you. So you want to take a look at, I think, DKNG, is that DraftKings, and then FLUT. Sure. So FanDuel. And then I'm going to look at gambling.com, which is a different business model, but let's take a look. And I think I know the story why. So it has something to do with Robinhood. Let's take a look. All right. So DraftKings is in the gambling space, and I'm going to open up so what's the second symbol? FU FanDuel. So FanDuel. Let me try just FanDuel. Is FanDuel publicly traded? I'm not finding the second symbol. So get me a second symbol, please, on that. For now, I'll go to gambling. But I'll start with the story as to why DraftKings is probably selling off. Our friends over at Robinhood, if you may have heard the news that the reason the stock's going so much higher is, and I covered this for months, I don't think it was, that big of news before, but Robinhood basically put gambling on their website. It's they really, their business is more like the business that Polymarket has, where you can, in essence, bet on events that are happening, right? Like here's Polymarket. You can bet on, hey, will Nike beat earnings, right? Well, now, yeah, they beat earnings, an election and so forth. So this type of experience, Robinhood has put it on their website, and it's really working. And they're doing it through a contract. Like if you were to say, hey, I'm willing to bet that the Reds are going to beat the Dodgers, you would in essence be buying a contract, like a futures contract, that you believe the Reds are going to win. And you would in essence put up an amount of money at risk. And if you're correct, you win, you made a return. If you're incorrect, you lose. You lose the amount you paid for that contract. That's the news that took Robinhood up, I guess, collectively about 16 to 18% over 2 days. And if Robinhood is getting, I think they've written over 4 billion contracts. It's been a wild success. Well, if people are buying contracts, gambling on Robinhood, they're probably not going to gamble as much on DraftKings. So I think that's the cause and effect. So it's not quoted here, but I'm a Robinhood investor. I have been tracking this whole business that they were launching. It's going really well. And Robinhood in a way is kind of like the threatening party to DraftKings. I think that's why DraftKings is selling off so much. Let's take a look at DraftKings fundamentals and see what they look like. See if this is a discounted stock. So DraftKings has $18.5 billion in market cap. Revenue is $5.4 billion. And forward P is a little high at 45. We'll see how fast they're growing. Analysts think it's really discounted. Over the year to date, it's flat. Over the 1 year, it's losing a little bit of money. Hasn't been a success. DraftKings has not been a successful investment, I don't think, for investors over the long haul. Growth looks good, 25%. Hey, that's looking good to me. The last quarter too, 36.95. And we're getting into football season. And as you guys know, football, American football is king. Gets a lot of eyeballs, gets a lot of people gambling. And I'm sure DraftKings has got millions of fantasy leagues going on at once. So this looks really good. This growth looks fantastic. Now, it's one thing to grow that top line, but are they really profitable? Do they generate cash flow? Let's take a peek. So cash flow is being generated. The yield on cash flow isn't great. It's 11% and it's inconsistent. You see that it hasn't been consistently growing. And so it's kind of all over the place there. The gross margins have not been consistent. We had really good gross margins. I'm in the quarterly. Let me get out of the quarterly. Maybe that's why it gave me some wild numbers. So they've cash flowed in 2024. Trailing 12 months is $500 million of cash flow. Looks good. And gross margins 43%. So the gross margins are not great. Okay. They're not fantastic. Fantastic is 80, 90% gross margins, and 43 is not fantastic. They're not profitable. Okay. So they're not showing great fundamentals. I like the growth, but the other fundamentals don't look fantastic to me. Okay. So $500 million in free cash flow. We'll value this stock in a minute. All right. So analysts are favorable on the stock. Every analyst, and you got 24 of them putting a price target, believes this stock is discounted. That's a pretty substantial consensus discount on the stock. And it's based on earnings per share. When we look at their growth, they're going to keep growing. So the market is treating the situation, which is Robinhood is doing really well with their, gambling, product, and putting pressure on the other players like DraftKings. So that story, the market's kind of taking it at face value and saying, hey, that's Robinhood's probably going to win that battle. I don't know. I'm a Robinhood stockholder, right? So I would, if anything, root for Robinhood. But I think that DraftKings is really a specialist when it comes to gambling around sports. And I think people that enjoy, gambling on sports are still going to probably prefer the experience on DraftKings. I think their growth is going to continue. The story may be creating a discount. We'll see in a little bit that they're discounted based on cash flow. Earnings per share are going to expand nicely. Look at this growth on earnings per share. Those are fantastic growth numbers. All right. So let's get into a valuation for DraftKings and see where this one's going to land from a valuation perspective. As I do that, let me say hello to Herdo. Good to see you. All right. So I'm going to open up a browser that you guys can't see so I could work my two screens and update a valuation on DraftKings. All right. So I do not have a valuation on DraftKings, but I'm going to put them next to gambling.com. Now, gambling.com does not take any bets. They just sell, or I should say they publish information on events, games, that people gamble on. And they provide that information. Gamblers want an edge. So they go to gambling.com and get that information. And while they're there, gambling.com will advertise on their website, which is how they make their money. They advertise while people are on their website, similar to like what Facebook does. And that's how they make money. I think it's a neat little business, growing well, but I'm not going to talk about gambling. I'm going to talk about DraftKings and see if it's a good bet or not. All right. So I wasn't sure if I'm going to take a look at their balance sheet and see where they should land from a discount rate. The margins weren't great, by the way. So I'm going to park a 9 there for now. And their free cash flow was $500 billion. So let me take a look at those fundamentals, and then I'll start updating this model. Right now, I'm valuing DraftKings based on the cash flow I think this company is going to produce in the future. And what I'm doing is I'm putting in the trailing 12 months, which is $501 million. And then we're going to grow it by a particular growth rate. Now, their top line growth is growing nicely at 25%. And looks like very good growth. And they've been a consistent grower, by the way. I think that the DraftKings brand is a good one. I think very recognized. People, when they gamble, they want to go somewhere where they probably feel assured that, hey, if I make a bet, I'm going to get paid my winnings. You know, it's kind of like casinos. Casinos can get a bad name really fast. Let's say a gambler goes and then they don't get paid on their gamblings. They'd probably get a bad reputation, and gamblers wouldn't go there. All right, let's take a look at the balance sheet. I hadn't looked at the balance sheet. Balance sheet's really important. We don't want a business with a bunch of debt, because that's just a problem. We don't want problems. We want good investments. So they have $1.2 billion in cash. They have $1.910 billion of debt. Not too bad. I think their debt to EBITDA is pretty low. So no problem on the balance sheet. They've got a good balance sheet. Now let me update my share count. Then we'll be able to see how they price compared to their free cash flow valuation. So we've got shares outstanding, 496 million shares. Well, you get a whopping 1% discount on DraftKings. It's not much of a discount. It's those margins. Those margins are showing up. Like I showed Airbnb a little earlier, and they were just cranking out cash because they have huge margins, like 85% margins. And when you have those really fat margins, you get to keep a lot of it in the form of profits and cash. DraftKings doesn't have big margins. They have like 40, 43% gross margins. So that's a starting point that isn't very high. Gambling.com, another example, their margins are like 80%. So I really like high margins. Who doesn't, right? High margins is like, you know, the difference between you have a job offered to you and they're going to pay you $25 an hour. In a different job, they offer you $100 an hour. Hey, easy decision. I'll take the one for $100 an hour. Yeah, I'm going to pay more taxes. Yeah, I'm going to have, maybe they ask me to take some training in advance, but $100 an hour, those are like margins. If you have higher margins, that company is getting paid more. Every $1 million of revenue, they get to keep more of it. So that's why margins are important to me. All right, let's keep moving along and take a look at the earnings per share, see what's going on there. So earnings per share, and I'm using 2026 numbers because tomorrow we're going to start the fourth quarter of 2025. Most of 2025 is behind us. It is time to focus on 2026. These guys are growing nicely, but their margins are low. So 25 is fine. They're going to grow that profit really fast, by the way. That looks really good. So when I look at the valuation, I would calculate on DraftKings based on the free cash flow that DraftKings produces. They are fairly priced with a 9% discount. Now, can somebody argue and say, well, it should be 8.5? Yeah, but I'm going to go with 9. And those low margins, I'm gonna harp on that because it's the type of investing that I like to do. Earnings per share looks pretty decent, 23% discount if I value the profits that I expect in the future in today's value. And when I combine the two, putting more weight in the free cash flow method, it's a 10% discount. It's not enough. We know that DraftKings is going to have competition. A new player is in their space, Robinhood, that has a lot of momentum. Now, do I think Robinhood's going to take a lot of share from DraftKings? No, I don't. But you got to offer me a nice discount in order for me to buy into DraftKings, maybe a 40% discount. So I could see myself making a nice 30 to 50% rate of return on this stock if I own it for a year or two. If I get a 10% discount, that means that maybe I'll make 10% over the course of a year. It's not enough. It's not enough. You got to offer me a nice discount. And let me just show you our friends over at Robinhood so that you can see what kind of like money those guys are cranking out. So Robinhood has a tremendous valuation. So I showed that with DraftKings, they were making $500 million in free cash. Our friends at Robinhood are doing more than $5 billion. The growth rate on Robinhood is like 60, 70%, really exciting. Earnings per share is somewhere in the neighborhood of where you would put DraftKings. And I'm only giving them a PE of 36 with a high growth business. But it's this cash flow that makes them really valuable. And I've always been attracted to Robinhood because of this cash generation. I still think Robinhood's discounted by 38%, but believe that the run up in Robinhood, they're probably going to give up some of those gains. I'm not buying any shares because I own a lot of Robinhood. So I don't need to buy any more shares. The market basically added 16, 18% more Robinhood value to my portfolio without me doing anything over for the last 2 days. So thank you, stock market, for making my Robinhood stock more valuable. But let's put the finishing touches on DraftKings. This guy here is, hold on a second. What? I already had it. So it looks like I already had it in here. Previously, I had been using a trailing 12 months number. That looks correct. That looks a little high. This is the 8.5. I decided to go, not 90. Yep. We end up with the same kind of valuation. Looks like I doubled down on DraftKings. Sorry about that. I didn't know I had already done the work before, and I did this on September 6th. But the growth rates, I think, are going to be closer to 25% growth on cash. And that's what I'm going to go with there. So DraftKings is going to be a pass. If they offered a better discount, I'd be all over it. So thanks for asking about DraftKings, and we'll see how things play out. Again, I don't think that Robinhood is going to be disrupted by Robinhood. I think it's just a story that is going to affect them. It's kind of like the story that's affecting Instacart, that, hey, you've got some of the companies that operate in their ecosystem making partnerships and putting a threat on Instacart. Same thing with DraftKings and Robinhood. All right, so that was Robinhood. Now let's take a look at, and I think you gave me the other symbol. So it's FLUT. FLUT. So I'm still not finding it. So FanDuel. And even when I put FanDuel, it's not in there. FanDuel. Yeah, I'm not finding FanDuel. That's weird, because I know FanDuel exists. So sorry, I can't look that one up. Bigger parent company owns FanDuel. So who owns it? So Flutter Entertainment. Okay. Now it's making sense. All right. Okay. So Flutter Entertainment owns FanDuel. Got it. Okay. So these guys are bigger than DraftKings, and they had a bad day. I think it's the same story that's affecting these guys. Hey, Robinhood's coming into your space and entering into your market. And these guys have a market cap of 44.66 billion, revenues of 14.89 billion. PE is really high for the current year. Forward P for the following year, 2026, looks pretty good. It's discounted according to analysts. So these guys are not growing as fast as DraftKings. DraftKings was smaller. Let's see here. DraftKings was 5.4 billion. Flutter is almost 3 times bigger, and they're growing at 15.6%. The growth rate is somewhat consistent, so that looks okay. All right, so let's take a look at their margins. So free cash flow, better on the free cash flow front. So Flutter is almost 3 times bigger. DraftKings was generating about 500 million in free cash. These guys are at 1.3. So they're about the same ratio. Gross margins, about the same amount, 40, a little better. Flutter's a little better, 46.9. I think DraftKings was lower. But see, these profit margins are not exciting. And these are mature businesses, right? This isn't like they started a couple years ago. No, they've been around for a while, like 15 years. So these numbers are not fantastic. Okay, this is where I lose my interest in this particular industry, because for what these guys do, I could find social apps like right now I'm buying into Pinterest. They have 85% gross margins. They have way better profitability. They have just as good or better growth rates. So, hey, although I don't use Pinterest, I'll buy the stock and make money. I've made a lot of money on Facebook Meta. I've made a lot of money on Reddit. Those are similar businesses that make far more money. So these margins are my big hang up with both Flutter and DraftKings. That's what's really, making these companies less desirable than other alternatives for investments that I have. These guys are being rated well by analysts, 380 million, 275. And based on earnings per share, I'm not going to argue that they probably value better on earnings per share than free cash flow. I just showed you the margins and that they don't produce a lot of free cash. But I would say that Flutter would be a pass for me along with DraftKings. The other piece that I would point to is a lot of product companies, service companies that are easily recognizable by retail investors. They tend to be priced a little higher because investors recognize them. Hey, I've bet on DraftKings. I've bet on FanDuel. I'm very familiar with that business. I'm comfortable buying the stock. Great. It's kind of like Nike. People are interested or comfortable in investing in Nike because everybody knows what Nike's all about. Well, that's good and bad at the same time. It's good it's recognized, but maybe the stock's priced a little too high, above where it should be, just because it's such a recognized brand. And I think it's good to have a good brand, but it's more important to have great fundamentals if I'm going to invest my capital, my hard-earned money into a company. So that's my review of Flutter and DraftKings. Thanks for asking. Thanks for sponsoring the Super Chat. And I'm glad we were able to look at both. So thanks for asking about those. All right. Shadow Guy. Yep. Got that comment. Hey, Herdo, good to see you. You want to see QFin? All right, I'll put that on the list. I think I've got a couple of stocks on the list, so bear with me. I think I've got like 6 or 7 stocks on the list. All right. Good chatter on the chat. All right, cool. Yeah, Lauren, thanks again. Appreciate you. Good luck. All right, so next one we're going to get into is Dave. Dave has been breaking hearts, investor hearts. This is a small cap, okay? So small caps, investor, be aware. When you invest in these small caps, They could take off and just, man, reward you real fast. They could also do unexpected things. Like for the last 5 days, this one's down 14%. Last month, down 6.5. Year to date, up 129%. Jeez. It's like, holy smokes. It's all over the place. And I think these guys have a very good business. When I look at what they do, I'm optimistic. When I started investing in Robinhood, I qualitatively assessed, okay, does the Robinhood business make sense? Are they going to capture a part of the market and really just dominate a part of the market? The answer was yes. Okay. When I look at Dave, I kind of have a similar kind of high level qualitative assessment that what they're doing is unique in the market and they're going to capture and dominate a part of the market. They're not going after Chase as a bank or Bank of America. No, you know what? That's old school. They know what they're doing over there. These guys are doing financial products for, individuals, consumers that are doing side hustles. They have easier kind of to manage bank account, loans. You can manage your savings on the account. So this is made for a younger person, right? Somebody who probably likes this look and feel better. They probably have a fantastic phone app, and everything's made kind of like with the new expectations, right? Everybody Venmos now. Everybody's like totally comfortable with gig economy and all that stuff. And these guys are really making their business and forming it around the way that the younger person likes to transact. I love that about them. And I think if they can dominate that piece of the market, they're going to do just fine. Now, it's one thing to believe in the high level story, but we got to look at the fundamentals, because I may like the business. I may think, hey, that's a good idea, but are the fundamentals there to support the business? So let's take a look. Well, I think this growth is fantastic, 48%, and 64 is even more fantastic. So if these guys grow at these rates, I'm in. Unique proposition to the market. Their fundamental top line growth looks excellent. Are they profitable? Gross margins, 67%, and they're a young company. And you see that they're getting better. As they get bigger, they're going to be more profitable. So as they become larger, they have a bigger mass of revenue, bigger margins. I love where this business is going. If they keep that top line growing, excellent things are going to happen for Dave. So I like the fundamentals. I could see why investors were really crazy about this stock and it's gone up so fast, because I'm seeing really good fundamentals and potentially a business that's going to be worth a lot more. This is different but similar what I was seeing in Robinhood when I started looking at it 2 years ago and thinking, man, that's a good investment. And that one's really gone up fast. These guys have more cash than debt. Beautiful. That's what we want to see. Solid balance sheet. What are analysts thinking? 6 of them cover this stock. The most optimistic one has a price target of $320 a share. Okay, that's pretty good. And the most careful, cautious analyst is at 177. So overall, they think it's discounted by 33%. And sorry, I skipped through the forecast. So this forecast worries me a bit. Now, if they go from 48 to 15, we got a problem. But let's take a look at how they're guiding. I think when I reviewed this stock previously, we looked at the guidance that the company was providing. I'm going to look at that next, because I can tell you if they're going from 48% growth down to 15, I am worried. It's like, wait a second, you got to keep growing fast. If you don't keep growing fast, your stock's not going to do well. So let's go over the Dave website here. Let's see if they're going to make it easy here. So I'm going to go with Dave. Investor relations, and see what they were guiding on their last earnings. All right, so here's their last earnings. So here they provided guidance for the year. Okay, we got that. So they moved their guidance up. They were at like 33 to 37% growth. Now they're growing at 46 to 48. So where are analysts getting those low growth rates? I'm seeing like really good growth. So growth looks good. What I'm going to do is, when is their earnings? November 11th. So I'm going to study that earnings and see how they're guiding for, because they're going to report the third quarter that just finished here, September 30th. And they're going to be guiding and say, the next quarter, and probably provide high level guidance for 2026. That's going to be really important. That's going to move the stock. If they come in and say, we're going to grow at 35%, this stock's going to keep working. It's going to keep moving higher. If they do surprise and say, we're only going to grow at like 10%, this stock is going to lose a lot of value or a lot of price. So I'm not buying any more shares until November 11th. I'm sitting on a gain. I'm okay with the stock, but I need to wait for this stock to give me more information, and then I'll make a decision whether I want to put more capital into it. I like the business. I like the growth. And I just need to see that they're going to continue to grow, and then I'll put more capital into it. But, it's a small cap, and FYI, we're in an expensive market. If we have sell-offs in October, we're going to see these small caps go down more, because that's just the nature of small caps. Small caps sell off faster than large caps, large, well-known caps. All right. So moving along, let's take a look at RNBY. Somebody asked about RNBY. RNBY. So I'm not finding RNBY. So who asked about RNBY? Let's take a look here. So whoever asked about RNBY, can you get me a little RM? So I think I noted it wrong. So RNMBY. Rheinmetall. All right. Okay. So Brandon asked about this. Okay, perfect. Thank you, Brandon. All right. So what do these guys do? This is a pretty big cap. This is in US dollars, 106 billion. So Rheinmetall AG provides mobility and security technologies in Germany and the rest of Europe. Okay. So are they like an Uber? So aerospace and defense. So do they do drones, or let's find that out. So they do mobility. So they do e-power solutions, charging infrastructure, air management, synthetic fuels. So they design batteries. Okay. So they're a product company. Okay. So I get that. I think I got myself in the German site. All right. Let's get back to English. And so industry. So they do a variety of industrial products. Solar, hydrogen. They're getting involved with energy production or products that are part of energy production. Okay. So I kind of have a gist. It's in industrial. They do some products that go in aerospace and defense. Got it. Okay. And we know that for the last year in Germany specifically, there's been a big rally in aerospace and defense companies. So these guys really went up in value, 333% over the 5-year. You see that this one was just a good stock probably, but then it just really cranked up starting about a year ago, less than a year ago, about 9 months ago. It just really cranked up. And I think it was around the story that the now president let the, European countries know that, hey, you'll have to like build up your military. And, I'll just, from what I remember, it was just made them aware that, hey, you're going to have to defend yourself. So you're going to have to build out your military. So these companies received a lot of new orders, a lot of investor money, because the expectation is that they're going to do really well for a number of years as militaries in Europe build up their militaries. These guys have been growing quite nicely, 31%, 35%. So you see that it's not just a story. We're seeing fundamental data show that they really are, in fact, growing nicely. Now, do they deserve a 300 and some odd % rise in their stock? I don't know. Let's keep looking. Let's look at the quarterly as well. So it could be a little choppy. So I'm not going to get overly concerned with, going down 8.77 for now, but you got to keep watching this. And if you see that, hey, you know what? They went from 8.7 to 6.5, and then they put up another single digit number, then that's really a trend. That would be letting us know that they're going to slow down in their growth, and that would not be good. All right. So taking a look at their cash flow, they don't cash flow very well. This is a $100 billion company. They don't produce more than $1 billion of cash. So your cash, the rate of cash is really low. Gross margins are decent, but not great, 51%. And they are profitable. So these numbers are not overly exciting to me. I think you can find other businesses, other industries that have exciting numbers, that have a profit margin of 35, that have a free cash flow margin of 30 to 40%. This is not it. So they have grown their top line. That does look really good, but they're not really, really profitable. Let's take a look at their balance sheet. I expect they have a good balance sheet. They have $2.36 billion of debt with $413 million of cash. Debt to EBITDA is 1. So the balance sheet's in good health. They have a little bit of debt, but not too much. So we looked at their growth rate, statistics. Now let me look at their earnings per share. So earnings per share, $18.67. It is growing nicely, the profitability. Right now, with a lot of orders coming in, they probably have better pricing power, which is good. $18 per share. So these guys are probably being valued by analysts or people that are buying the stock based on earnings per share. But I'm certain that I'm not going to get to $106 billion of market cap with less than $1 billion of free cash flow that's being produced. I would say at best, I'm going to get to 30, maybe $35 billion of market cap. This one would not be a stock that I'd be interested in. The problem is pretty much the stock's gone up 333%. So when, let's say 200% ago, maybe it was fairly priced, but now it's priced really high. And for me, I'd be worried that, hey, I'm going to buy the stock and it's already beginning to plateau. And then the stock's not going to perform all that well. I just shared that I don't like the fundamentals, the free cash flow, yield, and the margins are not great. So I would be staying out of this stock. It's just too expensive. If I was offered like a 35% discount, maybe, but I think investors are buying at a big premium. And will these guys, sustain that growth? Maybe. If they don't, it's going to be a punishment to investors that are in the stock, potentially, because the stock will come down. But we'll see. We'll see. It's been interesting that they grew that quickly, but not all industries are made the same, right? There's a reason why the most valuable companies all have really high gross margins, profit margins, cash flow rates. It's no accident. That's what I'm looking for. I'm looking for like a Reddit-like company that just has gone up in value and they have great fundamentals behind it. So thanks for asking about that one. And sorry that I got the ticker wrong. All right. So I think the next one we're going to talk about, I brought up Reddit. So let's talk about Reddit. Somebody said that maybe it was selling off recently. I think it had been. It had gone up too fast, right? So we got this stock's coming down a bit over the last 5 days. It's down 3%. It's had a couple tough days, but even the monthly looks good. Year to date, and this doesn't really tell us the story. The opportunity with Reddit was that, Reddit is a business that it's a social app. And they IPO'd in 2024 in March. So they've been public for about a year and a half. And the stock ran up and they gave us more earnings, right? They were able to operate and provide earnings reports. And then the stock sold off. Well, when it sold off, it became a terrific opportunity that I took advantage of. And the stock's up 164% from the low point. It was a terrific opportunity to buy around this range, which is when I bought. And then I just sat on my shares and the stock's doing really, really well. I've more than doubled my money on Reddit in less than a year. And the reason why I really like this business was that, I'm like a broken record. I apologize. This is kind of a mid-cap stock. But when we get into sales growth, revenue growth, 70%. Well, that's a very, very good number. That's an exciting number. And do you get to keep a lot of that revenue? Well, you got gross margins of 91%. And they're still a young business, still getting bigger and getting more operationally efficient. So if you start with 91, you get to keep a lot of that money. So that number excited me. The top line and the gross margin was very exciting. Since they're a young business, I'm okay not to over focus on profit just now. As they get bigger and have to buy fewer servers and hire people to, manage the Reddit network, they're going to get better at producing cash and profits. At this point, they're already producing 23.79% cash yield. That's terrific. So they're producing cash. They're young. They're growing really fast. And that's why the valuation was really good. And I jumped into Reddit. So Reddit may be having a couple rough weeks. It's still not come down in price enough for me to want to buy more shares, by the way. It went up too much for it to be discounted. Right now, I think Reddit's priced 26% too high. So I'm just going to sit tight, hold my shares, look for the next earnings to come up. And if it were to really sell off again, like it did in the March, April timeframe, I'm ready to buy shares because I think Reddit's going to be worth a lot more in the future. So that is Reddit. No cause for concern, in my opinion. I am holding my shares. I don't think it's discounted, but you guys make your decisions on Reddit. I'm not buying any more shares. I'm waiting for this to either give me more newer information that changes my valuation, and then I'm compelled to buy more shares. Or if the stock price were to sell off, then maybe that's an opportunity. So, all right, perfect. So that was Reddit. And it looks like Brandon on RNMBY, you're sitting on a big gain. Congratulations. Nicely done getting into a stock that looks that great. And keep me informed about what you do. Hopefully it keeps going up. But I gave you my opinion on it. It's just one opinion, by the way, on that company. All right, so that is Reddit. And I think we wanted to move to QFin. So I thought I was going to cover Spotify because they announced that their founder CEO is going to turn the reins over to some new co-CEOs. Now, QFin, these guys are in China, and they do financial services. Of course, they spin a little AI in there. And over the year to date, not doing great. Over the 1 year, not doing well. 5 year looks kind of interesting that it really had a nice run up starting in 2024, but then it really sold off. Small cap. And this is where my interest kind of goes away. They're not big, right? In financial services, 18.7. And this is in the Chinese currency. So I think that's 0.14. So that's like 2.2 billion in US revenue. And they're growing less than 10%. Well, that's not exciting. I just showed you Reddit growing at whatever they were growing, just really fast growth. If I was going to be excited about a Chinese stock, it'd have to be growing like Futu. Futu's growing really fast. This one's not. So this one's kind of not a stock that I'm ready to jump into. And based on this growth rate, I'm actually concerned. It's like, why can't you grow faster? You're small. And quarterly, it's kind of a little bit all over the place. It does look good for the last quarter, right? So if they start a nice positive trend where they're growing 25, 50%, that'd look really good. But, investing in China takes more risk as a U.S. investor. I'm absorbing more risk, and I need to be careful because small caps are really risky, and then investing in China is risky. So I'm multiplying the risk, and I just showed you that the company's not growing all that fast. So I'm not overly excited about QFin. We have two analysts covering it, and they think it's discounted by a big amount. They're basing it on earnings per share, and their forecast for sales growth is not exciting. I would pass. If this is a accurate forecast, I'm not in. And it's just not exciting enough. It'd be one thing if they were gigantic, like Alibaba's really big, but these guys are not that big. And if you look at like C enterprises, they're growing faster. A lot of businesses in China that are much bigger are growing much faster. So this one's kind of a little bit of a dead on arrival situation because I just don't see the growth. I'm not excited about it. When I look at a company, I first want to buy into high level qualitative analysis of the company. And do I believe in that business? Do I think they're going to be something, right? And on that one, I kind of disqualify it early, even though it's highly discounted. Now, if they start showing better growth, I'm in. If they start showing, 40, 50% growth on the top line, then that would be kind of an important qualifier. And a discount is interesting that is available on QFin, but what's going to grab the market's attention is a company with momentum, with positive momentum, and these guys, I don't think have it. So those are my comments on QFin. All right, so we covered. I think we had a lot of comments. Thanks everybody, and I think I covered most of them. Um, I did want to comment on a couple of things. Pfizer had a good day, and that's Pfizer during Donald Trump's first term, they had a very good relationship with the president, and they have a good one again. And I think they were able to address, I think, some of the, you know, issues around the cost of pharmaceuticals. So that in partnership with the White House, they announced something today. It helped the stock. Now, it helped the stock for one day. I still think that Pfizer has a growing problem. They're guiding. It doesn't show up here, but when you look at their guidance, and I'm a stockholder of Pfizer, they're guiding that they're going to have very flat growth. That's my biggest problem with the stock. I don't own a lot of it, but look at this growth. No growth. Negative, negative, negative. So I'm like, man, I'm thinking I'm going to sell all my Pfizer stock. It's a pretty good time to sell it now that they've got a nice little bump of 6%. We'll see. I'm going to make a decision on Pfizer, but that's what happened today that caused the stock to go up. Amazon, you know, amazingly. So you guys that have been on streams and on investor calls, you guys probably remember how I was talking about Google Alphabet and my, again, qualitative review of Google Alphabet is this is a terrific business, excellent business. And these comments I was making back here. And the market is not being rational in valuing Google Alphabet for what they are, which is one of the most important companies operating out there. And as a result, you know, later on, I bought shares here. I own a lot of Google Alphabet, and it's really done well. For the last couple months, this stock has done great. So let's talk about Amazon. And Amazon for the 1 year, that doesn't tell us the picture. This tells us the picture, I should say. This is the picture that I want to paint. The stock's not doing anything year to date, but Amazon has a culture that it's not that they don't care what their stock price is doing. It's not the priority. The priority is to make the business better, to obsess on the customer, to make themselves more valuable, more efficient, just all the things that you want in a solid business. Amazon's obsessed with that. And I really like that about them. And I think that this is going to be, you know, if we fast forward a year, this is going to be the next Google Alphabet. It's going to go up 30, 40%. And it's going to be basically because this obviously, it should be obvious that this is a very powerful business, starting with the fact that they are the biggest revenue publicly traded company in the United States of America, growing at 11% growth. They put roughly $65 billion to $70 billion of value dollars on their top line revenue line every year. They're going to be $1 trillion value revenue company in 4 or 5 years. That's going to be incredible. And they're doing it profitably while investing really, really big into data center, cloud, and all those things. Now, when we look at Nebius and CoreWeave, you know, just flourish. And those are pure play cloud infrastructure companies. You look at that and you go, interesting. So a lot of companies like Meta and everybody else is paying up to get data center capacity. Well, Amazon's number one cloud infrastructure company in the world. And I looked at their growth rates that are expected with AWS. That is going to accelerate. The growth in the data center is going to accelerate from Amazon. So this one here is one of those stocks I continue to buy shares in Amazon. I bought more shares today. Every week I'm buying more Amazon. I want Amazon to be a top 3 holding for me. I just feel that much confidence in their business as a whole, and feel that the market, is offering me a really nice situation. Hey, it's not up like a bunch of other stocks, and the market cap is high, but it's going to go much higher. It's just one of those businesses that I have a strong conviction is going to be probably a $5 trillion market cap company in the next 2-3 years. It's just going to be that it's that important. It's going to be that priced accordingly. Once they get some of the cloud business growth and they get to expand their margins, this business is just going to flourish. So Amazon's been an opportunity that has come up, and I'll gladly take it. I talked about DocuSign, and DocuSign got smashed because OpenAI announced, hey, we're going to put a document management app out there. Well, that's great. I don't think they're going to disrupt DocuSign, because DocuSign is used by companies that are signing contracts, law firms, real estate agents, just all kinds of different use cases where electronic signatures are required. ChatGPT is not going to disrupt that. ChatGPT has been a success, but it's been a success with consumers, especially young consumers. Young consumers are not signing contracts. DocuSign's kind of far and away from ChatGPT. So I bought more shares in DocuSign today. I think it's an opportunity, and don't think it's going to be a long-term impact on them. It did take their stock down to the negative over the 30-day. Year to date's down, but it's doing okay. Even with that 12% 12% drop today, still up 16.9. This is a growing business. Now, they're not growing, tremendously, 8%. But when you look at the margins, they're just very desirable margins. Almost 80% gross margins, profit margins of 9%, free cash flow margins of 30%. So this is a very, very profitable business that keeps buying back shares. So I think DocuSign is going to be fine, and we'll see how things play out for them. All right, I think that's a good spot to end the stream. Everybody, thanks for tuning in. I'm going to stream again in the morning. So if you can't make it, you can see the recording, but I'll be back with Daryl, who will be doing the charts. I'll be doing the fundamental analysis, and we'll go from there. Really appreciate everybody attending. Man, we had a lot of people with a lot of comments, and it's always tough when I'm doing the streams on my own to keep up with the comments. So I apologize if I missed one of yours. Didn't mean to. It's just I'm overwhelmed by so many messages, and I really appreciate everybody attending. Thank you so much. And if you're a member and we're heading into a live stream, you could always email me or message me on Discord, and then I can note the stocks you want me to cover. Just keep that in mind. All right, everybody. So have a terrific evening. I really appreciate your attention for the last 90 minutes. And we're heading into Q4 tomorrow, beginning at Q4. I already looked at my performance for the first 9 months of the year. Very good so far. Very good rate of return. I've made more money this year to date than ever before. And we'll see how we trade for the rest of the year. I wouldn't be surprised if we have a good sell-off, but I thought September might bring a nice correction. It didn't. So October, if it doesn't bring a big correction, I won't be shocked. If it does, I won't be shocked. I'm actually prepared. I have a good pile of cash ready to buy some more stocks. I'm trying to rotate out of some weak stocks and really strengthen some stocks that I'm really building positions around. For example, Amazon being one of them. So I'll continue to talk about what I'm doing there. And please keep bringing the stocks that you're interested in to the live streams, as well as the investor calls that we have. Thanks again, everybody. Have a good night.